Over the years, we've found that about 90% of the common mistakes that business owners make have to do with taxes. Let's take a look at the most common mistakes we see early childhood education business owners make, so you can spot them and feel confident you'll know how to avoid them. Mistake number one that we come across is trying to do your own taxes as a business owner. Every year the tax code gets more and more complicated. In general, it's in your best interest as a business owner to have a certified public accountant or CPA do your business taxes. If you want to go ahead and do your personal taxes yourself, that's okay. But very often we see that the tax software our clients use doesn't automatically apply the qualified business income deduction. And since this tax break can result in significant savings, you definitely want to make sure your tax software applies this deduction to your personal taxes. Another tax mistake we see a lot is only talking to your tax preparer once a year. One of the biggest things we hear when talking with a prospective new client is, I have no idea what's going on. I send my tax preparer my taxes, I hear from them 3 or 4 months later, then I don't really hear anything else. No suggestions, guidance, recommendations, or anything like that. I hear you. It's frustrating to feel like you aren't on the same page as your tax accountant. A couple of things you might want to keep in mind here. If you're waiting until tax time to talk with your tax preparer, it's too late. After the tax year ends, there's not really a lot that can be done at this point. Also, tax season is the busiest time of the year for accountants. We simply don't have the capacity to analyse individual situations in great depth at that time. In fact, if we learn that a client only wants to work with us to do their tax return, we still request that they talk with us every quarter. We want to know their personal goals, business goals, and any major changes that have happened with the business. This helps us craft a long-term tax plan that will benefit our clients' personal and business goals. Another thing we come across a lot is a failure to make estimated tax payments. Honestly, that creates a painful situation for you and for your tax preparer. No tax preparer actually likes to tell somebody that they owe the IRS thousands of dollars at the end of the year. The way it works is that you need to pay in 100% of what you owed last year or 90% of what you are going to owe this year. If you don't do that, you'll be subject to an underpayment penalty. Even though the penalty is relatively small in the grand scheme of IRS penalties, it can be avoided if you spread out your estimated tax payments over the course of 4 quarters. You have a couple of options when it comes to making your estimated tax payments. One option is to have your tax preparer schedule automatic quarterly payments. Another option is to have your tax preparer calculate your taxes each quarter. Here's another mistake we see very frequently: setting up your business as a limited liability company or LLC, and then using your business bank account as a personal bank account. There are a lot of valid reasons to set up an LLC. One of the biggest ones is personal liability protection, so you're not personally responsible for your business's debts. Unfortunately, if you're using your business bank account for personal expenses, you're forfeiting your personal liability protection under the law. It's okay in most cases to transfer your tax business income to your personal account. That money belongs to you and you can spend it as you wish. But if the business pays your personal expenses directly out of the business account, you are showing economically that there's no difference between you and the business. So, if you get sued, the person or business suing you could go after your personal assets. To protect yourself from that scenario, you want to avoid making direct payments from your business bank account for personal purposes. The final tax-related mistake we see happening is switching payroll services in the middle of the year. This can present a problem for your business if all the payroll information is not transferred correctly or completely to your new payroll provider. Then you'll get a letter from the Social Security Administration saying that your W-2 and 941 tax return forms don't agree with each other, requiring you to file amendments. In general, if you are really unhappy with your payroll provider, we would strongly recommend waiting until the first payroll of January to make that switch so that all the records are together.